Hello and welcome to this week's episode of the Lenders Digest podcast by Jonathan Preston. And please do check out the newsletter at lendersdigest.substack.com. So this week we saw a much higher inflation figure than was expected, with inflation up 6.8% from 6.3% last month. This changes the rate expectations greatly, and more rate rises are now expected. So the question now is, will the recent price gains continue for the property market if we see further rate rises? And interestingly, we are seeing a similar dynamic in equities, particularly the S&P 500, with bond yields at high levels, and yet many indices are trending upward, and many countries' indices are actually at new all-time highs at the moment. Now, in Australian lending news, anecdotally, loan volumes seem to be picking up, and that's despite recent lending data showing that loan volumes are actually still declining. There seems to be more appetite from buyers to execute transactions, with a lot of my pre-approvals actually finding properties recently. However, the recent ABS data shows that new mortgages originated are 25.8% lower year on year and are down another 2.9% in April. So I wonder if it is the more capitalized players in the market now that are supporting prices. Now, in terms of Australian price property data this week, despite the upcoming fixed rate cliff and the ongoing concerns about interest rates, prices continue to trend higher on the back of low stock levels. This does appear to be somewhat area dependent, with premium areas outperforming currently. Sydney's price movement has been steadily trending upwards since February now, and FOMO, which is fear of missing out, I think might soon follow. And the media are starting to run stories about how price growth is heating up, so we will have to see how this plays out over the coming months as we move toward the spring selling season. Now, some recent data from CoreLogic has shown that combined regionals have gained only 0.8% in the last quarter versus 2.8% for combined capitals. Now, in terms of recent price data, in terms of peak to trough, Sydney was down 13.8% in the down move from January 22 to January 23 and has rebounded 4.8% since. Melbourne was down 9.6% from February 22 to February 23 and is up 1.6% from the bottom. Brisbane was down 11% from January 22 to February 23 and is up 1.8% from the bottom. Adelaide was down only 2.4% from July 22 to March 23 and is up 1.2% since. Perth fell only 0.9% between July 22 and February 23 and has gained 2.4% since. Hobart dropped 13% between May 22 and April 23 and is up 0.5% since then. Darwin fell 3.3% between August 22 and April 23 and is up 0.4% since. And ACT fell 9.5% between June 22 and April 23 and is up 0.4% since. Now, on the topic of media, I received an interesting email yesterday from PPD Real Estate, and it says, media outlets have been stirring things up in the rental market with reports of mega queues for properties and landlords being able to hike up rents and pick and choose a tenant when the reality is rather different. Katrina Borg, our new business executive, has been at the top of her game for 17 years and has never seen a market quite like it. Media hype is not the real picture, with most of those lining up to view a property there to check out their options. Katrina reports we're getting an average of 8 to 10 groups through our open homes, with about 20% of those actually wanting or needing to move. This is not a time to be putting rents up, and misinformation that's coming out of the media has caused a bit of a rent hysteria in the press that's filtered out with no actual credence. Feedback from tenants is they're looking to cut costs, so don't believe the hype about landlords being in a position to charge whatever they like to get a good tenant. A good example is a recent client who was paying $1,100 a week for a one-bedroom apartment in Rose Bay and was refused a reduction even though she paid more rent than was originally listed. She found a fabulous property in Bellevue Hill with stunning views, 2 bedrooms, a study, and off-street parking for the same rent. Our advice to landlords is to be realistic and to hang on to a good tenant. The market's recovering from COVID ramifications, and although there's a correction on the horizon, it's time to tighten the belt and ride it out. So, an interesting email that does seem at odds, though, with the inflation figures, and perhaps some early cracks, maybe are showing for properties in the higher price brackets for rental potentially. But yeah, very interesting email, and there are some new charts that have come out from the ABS which show that the rental market growth is very strong, up more than 19% in Sydney year over year. So that's a bit contradictory, but yeah, certainly some interesting comments. Now, in terms of inflation data in the US, Truflation's model has now inflation at 2.73%, and the UK is now at 13.19%. Over to oil and bonds. WTI crude oil dropped this week, down from $72.87 last week to $71.87 this week, which is not a significant move. The 2-year Treasury yield dropped only slightly from 4.568 last week to 4.512% this week, remaining at an elevated level relative to recent months. And the 10-year Treasury yield has remained within the same range for some time now. In terms of the ASX rate tracker pricing, this week we saw big moves in the yield curve, and so it now seems likely we'll see another rate hike in the coming months. The 30-day cash rate futures are only indicating a 37% chance of an increase this month. However, if we look at the yield curve, it actually has rates priced at 4.155% in September and 4.16% in October currently. So that indicates pretty much almost guaranteed a rate hike by that time. And in this week's business quote, "Smart money is just dumb money that's been through a crash," by Naval Ravikant. Thank you very much for tuning in.